Okay guys, welcome to my YouTube channel. So I'll be dropping another gem which is going to be over fair value gaps and how you can use it for entries and how you can use it to understand price and the right side of the market you are supposed to aim at. So we dive in. So fair value gaps. What is a fair value gap? A fair value gap is a theory candlestick pattern where the first candle's low does not overlap with the third candle's high, which is a bearish fair value gap. What does this mean? Where the first candle's low, which is this low right here, this low does not overlap with this third candle's high, which is this high. Like it's not overlapping. There's a gap in between, which is a bearish fair value gap. While for a bullish fair value gap, the first candle's high does not overlap with the third candle's low. The first, which is this, the first candle's high, this high, does not overlap with the third candle's low, which is 1, 2, 3. This low does not overlap with this high. There's a gap in between. Same scenario with the bearish. The first candle's low does not overlap with the third candle's high. 1, 2, 3. So, in other words, a fair value gap is a three candlestick pattern that creates a gap in between the first and the third candle. So there's this gap left in price. Let me draw this out. This gap left in price. As you can see, this first, second, third. There's this gap. So is that gap that our main focus is? This gap. Let's draw this 11. Now, my injury. So there's this gap. So this gap is our main focus. There's this gap left in price. So that's what this fair value gap is all about. This gap. So price is always magneted to this gap. So once price sees a gap, a theory candlestick pattern gap, price does this and then move in the direction it was earlier, which is lower. So now let's go to the bullish gap, where the first candle's high does not overlap with the third candle's low. That's what we're talking about. Just because as you can see, there's a gap. Same scenario. See, there's also a gap. So is this gap that price is always magneted to? So price draws to the gap and then continues in the actual direction it was going before. Like this is going lower, so price leaves a gap and then comes back and then continues going lower. You get? So that's what this fair value gap is all about. Leaving a gap in price for price to come back. You know, this is bullish. If price comes back, you're just supposed to go up or down. Let's go up like this, continue in the actual direction it was going earlier. So this is what candlestick this is the candlestick pattern for fair value gap. It's a three candlestick pattern. 1, 2, 3. The second candle has to have a gap in price for price to come back. So once price comes back into that with a clear bias that we are buying, then we buy and target any high. You can also use it as a draw on liquidity. For example, let's say you have multiple let's say the market has been going lower. In your mind, you know that you're not supposed to buy. Why? because there is a gap. And if you buy, market can go down, but you chill, wait for price to go back there before you sell. Before you sell like this. So that's in this scenario too. You won't be buying yet. You wait for price to come back to that gap before you do what? Before you buy. So that's what you need to know about fair value gaps. Okay. So now we know that this is a fair value gap. So what isn't a fair value gap? Okay, I'll get to that now. As you can see, there are gaps. The market is inefficient. It's leaving a gap. So by knowing this, the opposite is what we regard as an inefficiency or a balanced price. For example, you can see this first um candle's low is overlapping. This low is overlapping this third candle's high, like they are overlapping, like they are get intertwining. This one entered this one, you get, like they are overlapping, you get, side by side. You just mark your low to the third candle's low. You can see that there is no gap, there is no inefficiency or imbalance. It's an efficient price action. You get, same thing if we are bullish. So since there is no gap, there is no reason for price to come back here. Price will continue going lower till it creates a new gap again. Same thing with this other one. Price creates, so your main focus will be the wicks, these wicks, if they are overlapping or not. If it overlaps, then you know that fine. It's not a fair value gap. It's an efficient price action. So price are always magneted to gaps. They have to come back there. It's like a draw on liquidity. Price has to come back just to continue the initial trend it was in. So this is what I call an efficient candlestick pattern. Like this is what I call an efficient, because there's no gap left in price, so there's no reason for price to come back there. Price just price does this, price just continues going up without checking anything. But if there were to be a gap like earlier, it's price would have a reason to come back there. So this is what fair value gaps and uh, efficient price action is. Just a gap in price that price is drawn to, we get. So let's open the charts and delete all this bullshit. So this is my favorite pair, which is Euro USD, and this is the weekly time frame on Euro USD. Okay, so let's make some price action. Okay, so this is our buy side liquidity is taking, and let's say we are expecting price to go lower, expecting price to go to this weekly low. What are we looking for? We are looking for gaps of price to get to that particular low. As you can see, we have all these gaps here. Like I said, you can either use it as a draw on liquidity or an entry point. Okay, so you can see we have 1, 2, 3. This is the low I marked before. If you were following this low, as you can see, they are not overlapping. This first candle's low is not overlapping with this third candle's high. So price did what? Price came back to this price, and you can see the body is respecting this kind, like nobody's closing above it. For example, if I click on line charts, you see what I mean. Like price respected this zone, respected it, just came, went slower like that. So this is what I call efficient price action. As you can see, there are no gaps left again. This first, second, third, it doesn't matter the candle, the color of the candle though, you get. So as you can see, it's overlapping. It's this low and this high, they are overlapping. There is no gap. Price did not leave any, so there's no reason for price to do anything there again, you get. So you can just see gaps as where price wants to get, if price wants to go lower, or a draw on liquidity, you get. For example, we have this gap, price hasn't done anything, so we wait for price to either fill it up completely, continue going higher. As you can see, we also have this gap. I'm not showing you what fair gaps looks like. Not that you just see one and just go and enter one trade randomly. No, you have to understand where price is heading to and all those things. Just showing you examples of this is a sweet example. 1, 2, 3. This low, this first candle's high does not overlap, like to see the amount of gap left. So price has to come either 50% of this, price has to come lower, like price has to come in a discount. You can use this one. Price has to come lower before going up again. You can't, it has to fill it up to a certain point. You can't just see this small tap won't do anything. As you can see, price came back lower. It has to, because the deeper it enters the fair value gap, the better. That's just it. Okay. As you can see, we have this with fair value gap. Let me change the color of this thing. Like this. Okay. This is, and this is what a bullish fair value gap. Bullish fair value gap. The price came and then went higher. Now, let's say we want to trade now. We understand fair value gaps. How can we trade with this knowledge about fair value gaps? How can we trade? Let's go to the 4-hour time frame first. 4-hour time frame. You can, the gap is any, you can see this gap anywhere in price. It doesn't really have to be, you can see it anywhere on the daily, 4-hour, you can see it anywhere. So okay, now let's say price took out this high, because if you want to sell, price has to take a high before you can even think of selling. So after price takes a low, we'll talk about liquidity later, but for now our main focus is on fair value gaps. So price took a low. Like I said, if price wants to go down, it has to do what? It has to take a high. So price takes another high. Price is always tapping into something before selling. So now we are looking for fair value gaps. And let's go. let's go. Price ticks by side. Yeah, looking for an entry point. So as you can see, a price did what? Price went higher, then came lower. If you go to 15 minutes, this is a low. So 1, 2, 3. This low does not overlap with this high. What the price doing? Price came back. This is a bearish fair value gap. So it's always in price has to with all this impulse, price still came up before doing what? Before going down. Like that's what price does most of the time. Comes back to fair value gaps. Let's say price swept this low, wants to continue. We have this gap over here. We have this gap. 1, 2, 3. This low. First count is low. First count is high. Markets, as you can see. So like I said, so you that will be trying to buy, trying to act like you know more than the market. And some people know that there's a gap over here, to target this eye and see what happened. Price did what? Took them all the way out. Price took them out. Because price went lower. So that's like a magnet for price. Magnets. Okay, another low was taken over here. After this low, price did what? We have this sweet fair value gap. 1, 2, 3. A gap. Low. So this I see this is a bearish. As you can see, the candles are not closing above it, it's respecting it, and then sells off. So that's what price does. It fills fair value gaps. So let's look for buy type of fair value gap. So okay, this is I get taken. Now I want to buy, and to buy, price has to take a low before price buys. You get, if price wants to sell, price has to take a high. So we wait for this liquidity to be taken out. One of those markets is too slow. So price takes. Let me step side. Bottom left. So price did what? Price went higher. Is there any gap created in price? Yes, we have this one. 1, 2, 3. This candle's high. First candle's high. To this other one, you can see there's a gap in price. We have this gap over here. You can see price respected it and did what? And went higher. So this week, the week does like it doesn't have to close with a full body candle. It doesn't have to close with a week has to be shown. So if you want to buy, this would have been your those targets here, and stop loss will be with this low. If you go lower, you can see this low is a. Let's go to the 1 hour. This is what I'm talking about. So there's a low, and this low price didn't come near it, so this would have been, you can see, very tight. And again, the best way to find fair value gaps and the best way to find entries is, let's say for example, this 4 hour. If you want to get tight sniper entries, let me just tell you how you do that. Okay, let's say price did what went higher and we have this fair value gap. The best way to enter is to go lower and see. This is the 4 hour time frame. So go to the 1 hour and see if there's a fair value gap around this candle. You know it's 1, 2, 3. You go down to see if there's another fair value gap in the 1 hour. If there is, then that will be your entry. As you can see, we have 1, 2. Let me delete this one. Why am I whispering? As you can see, we have 1, 2, 3. These candles high, this candles low. There's a gap. So this would have been your entry. You get that would have been your sniper. Your sniper entry. So you can, well, there's another type of fair value gap, but I'll teach that in another time. To me, I have a particular pattern I enter. There's also what I call inverse fair value gap. What did I say? Inverse. Let me write it down. There's a lot for you guys to learn, but I'm just making this like class about fair value gaps. Our main focus is not to trade but to understand how these markets are engineered, which can be beneficial for us. Okay, so this inverse fair value gap occurs like this. Let's say this is our gap without the wicks. Let's say this is our gap. Let's say this is our gap. You know, initially this was you're supposed to like price supposed to do like this and come down. But price did what? Price disrespected this fair value gap and went higher, even closing above the theory pattern, whatever. So with this in mind, this is what you now do. You expect price to come back down, tap on this, and do what? Go higher. So this thing was like this before. You're expecting this to occur, but price disrespected it. It did not weak. So this becomes what? Inverse. Price. This becomes inverse. This is how I enter my trades actually. So let me show you that. And this is actually this inverse is a very crazy pattern. So let me show you how I've entered. So you know, initially we have this 1, 2, 3. We have this inverse fair value gap, this normal fair value gap. But price did what? This was our normal fair value gap. This was it. But price disrespected and continue higher. So we expect price to do what? To come back, enter, and then go up. Let me show you. So price did what? Price went high like this, did like this, and then go up. You can see how mad your trade would have been just by knowing that. So I was like, let me just put that in there as a bonus for. And again, it's occurred on the 4 hour time frame. The same inverse. That's so. See this place again. 1, 2, 3. We have this candles low, and this candles high. an overlap. So as you can see, price did what? Continue going higher, higher, higher. So these are the things to understand. And again, price also respected what? So these are multiple confirmations for you on how this fair value gap works. It's like a magnet for price. Price has to come back. If price doesn't come back, it can't rest. There's another on there's another gap. Yeah. What else can you see? There's also this one. So is that I use this normal one or use this one to enter. Again, broke this eye, favor the gap, went higher. So that's what this price does. So once price has gotten to where it wants to get to, you should expect if you start seeing bearish fair value gaps, for example, like this type of you start seeing this type of fair value gaps, you can see price expected. So yeah, that's that about fair value gaps, and now you can use them to make money. Fair value gap again. So multiple ones. If you know where you are in the market, for example, you're targeting this buy side initially. So we know that from if gap starts forming in this scene, as you can see, this one gets disrespected. This one, this big one. So it's not meant to be like candles are not meant to close above it. It's meant to be weak, but price is respected and did what reverse. As you can see, there's also this one here that price respects. So is either I use the inverse favored gap or the normal favored gap. But for beginning, you can start with this one. So price targets either use this one or this one. All you have to know is that price the deeper it gets into, the better. That sounds weird, but yeah, you get the drill. So that's that about favored gaps, and now you can actually use them to make money because and it's fractal, it's on every time frame. That's just the thing about this thing. It's on every time frame. It's on every if you see one in the 4 hour, for example, go to the 1 hour. If you see the 1 hour, go to the 50 minutes. You surely see they are always there for you. They're always there. This one is a gap now. Went higher. They're always there for you. If ever the gaps got your back. What's this? Looks familiar. An inverse favor gap. You see, so that's how you can use all these things to get your buyers, or you just see it as an argument. Bears were winning, so it was going down. All of a sudden, the bulls came back. And this thing looks suspicious. If he does this, that means I'm not sure it's like going down again. So you use this one to do what? To buy. So that's that about favorite gaps. So thanks for sticking to the end, even though this was a very long video. I hope you understand how these favorite gaps work and I can use them to make money. So you understand this favorite gap. Yeah. The fact that I knew where this thing was going to, this Euro USD, why? Why? What did I see in this chart? Pause the video. What can you see that made this thing go higher? Sensei, we can't see anything. Oh, fine. This inverse. Let me zoom it safe. This inverse favoring gap over here. This was what gave me, I think there's a gap. You can see. So boom. Imagine weekly time frame. It's kept on going up. So yeah. And before it stopped here, what happened before? There's a gap, one, two, three. So yeah, thank you for sticking to the end. And please can like, share, subscribe, comment something nice. It helps the algorithm and reaches the right audience. So yeah, thank you for sticking to the end. Till next time, and stay safe.